You got a chance to watch this video, didn't you?
I did, and it's a really good expose on the history of money in the United States, specifically around the dollar era, and revelations in the video that people maybe now are just waking up to, as we've had recent bank failures and things. And I think people will be maybe more receptive to this now than they would have been 5 or 10 years ago, prior to the last recession and what we've seen lately. So I think it's a really good documentary put out by PBS. I think it's got a lot of good points that we're going to go through.
There's an old quote that history doesn't repeat itself, but it rhymes. And this just goes back, the age of monetary policy. When you unclip the dollar from being backed up by gold, it allows you to just run the printing presses. And that tale is, I think, at its kind of final cycle. Wouldn't you agree?
Welcome to GoldSilver Pros.
The financial system globally has been built around extremely low, ultra low interest rates for 10 years. All of these things that got built up over the last decade are going to have to be dismantled or changed.
We will keep at it until we're confident the job is done. Thank you.
We lived in a bubble, in a dream, and this dream and a bubble is bursting.
Rising interest rates in the U.S. and many other countries are intensifying fears of a recession.
Ever since that Fed meeting at Jackson Hole, we've been getting mixed signals about the economy. Is it bound for recession, or is it in a booming recovery?
An economy with such a strong labor market is not in a recession.
At the center of the debate are the actions of the Federal Reserve, which seems to have our economic fate in its hands.
The Fed is trying to stop inflation, but is the medicine worse than the disease?
Yeah, I do agree. Back when we had the dollar pegged to gold under the original Bretton Woods after World War II, it offered stability to the global markets. Everybody depended upon the dollar. The dollar just naturally became the world's reserve currency. And that was a natural outgrowth of the strength of the United States becoming, one of the strongest nations, and also having that currency everybody depended on. And along the way, the United States started making agreements to trade oil in dollars. And so dollars became the dominant currency for that reason, because everybody uses oil. So contracts were negotiated there. And that lasted for quite a long time. But, in 1971, when Nixon pulled us off the gold standard, it really was due to the fact that we had printed extra money and people had figured it out. And they were saying, okay, we'll take your gold for that. And then I think 2/3 of the amount of gold the United States had at the time had been liquidated. And so there was concern about the dollar, and then the decisions were made. And then, the rest is history. We've seen the last 50 years since we've been on just a pure dollar standard. We've seen how it's just the growth of credit and the growth of money in society. And I think this documentary really talks about some of the effects of what happens when you go there. And this experiment's been tried before in other places, including the US, and it hasn't ended real well. And so the question is, really what happens to the dollar. And I think that's part of what this episode is going to be talking about as well, is what happens to the dollar in that case, what happens to currencies in that case, and how does that affect the rest of the economy?
You were thinking what?
I was thinking this is the craziest market I've seen in 40 years.
Those who follow the decision-making.
None of us think about this because it's boring, but it's everything. It touches everything.
And those who have been hit the hardest by it.
It's like choosing between your rent and your food.
They do not understand what everybody's going through.
It was the entitlements that Lyndon B. Johnson was passing. It's like all of a sudden, let's just give everybody everything. The age of easy money kind of really began back then, and we saw a lot of government programs come out and subsidy programs and things like that. And then if you kind of even go back further in history, the Great Depression, really the banks in Wall Street caused that too. History, right? But the Glass-Steagall Act came into place to really make banks act like banks instead of be investment houses gambling with depositors' money and frankly acting like Wall Street. So I really think in this modern age, it really kind of teed off when Clinton repealed that part of the Glass-Steagall Act and allowed banks to start acting like investment companies. And there's always like a fuse, a time delay that takes before there's a detonation, right? So that was back during the Clinton era, and it took all the way to 2008 when we had this big mortgage crisis and the banks almost shut down the global economy.
That's right. It's where the banks had taken customer money and put it in the commercial side. And why this never works, Nathan, is because they're looking for, they're taking money on a short-term basis with a short-term, they have to remit it back to their customers because it's not a time deposit, it's a regular deposit. But they're putting it into longer-term, more risky type of investments like mortgage-backed securities and other types of investments, treasuries, things like that. So when customers want access to their funds, they want access to their money, these banks have that money committed to longer term investments that have contracts on them. So they don't have enough liquidity always to give people money back. And essentially what we saw with the recent bank failures is that debt that a lot of these banks are investing in, the value of it had fallen. And the reason it had fallen is interest rates are rising. And on a bond, when the interest rates rise, the prices have to come down. Because for the next person to buy that bond, if interest rates have risen and they can go get a bond for 3%, but yours is 2%, you have to discount the price of your bond to get that person to buy it because they can go get a 3% one. Interest rates are rising. So it caused the valuations of all these banks' balance sheets to go negative, where they had more liabilities that they owed than what their assets are worth, and investors saw that and started taking their money out. So it's a double-edged sword. The banks really need that money for liquidity. But in order to operate, they take that short-term deposit money and they put it into the market. And when the value of their investments falls, they can't just liquidate it and pay their customer deposits back because they would go out of business. And that's really sort of the cycle that we're in. And like you said, it does take time for that to play out. It takes time for enough debt to be built to where the liabilities that they owe back to their consumers is higher than what they can get, because now that debt's come under pressure. And once that debt comes under pressure and prices start to fall on those assets, you begin to see what the real value of debt is. And debt is still debt. It's, they say it's an asset, but it's still debt. It's still something you have to pay back. And that's really what blows up financial systems, is that requirement to pay that debt back with interest at a time at which the economy is not doing well. And you don't have the liquidity to do that. And that's really what we've seen in the banking system lately.
Otherwise, it is going to leave the station without you.
Today, with Wall Street shaken to its very foundation today.
We are in the midst of a serious financial crisis, and the federal government is responding with decisive action.
The Bush administration.
The president and Congress spent hundreds of billions of dollars to restart the economy, but at the center of the rescue effort was the Federal Reserve. Richard Fisher was the head of the Fed's bank in Dallas at the time.
What the Federal Reserve does is provide the blood supply for the body of our capitalist economy. And what happened in 2008 is all the veins in the capillaries and the arteries collapsed. So every financial function had failed. It had collapsed, and we had to restore them.
Yeah, and I always kind of joke, like, only a government can be the problem and the solution, right? And I remember at that time, kind of the political propaganda was every American deserves the American dream of home ownership. Well, the problem was they loosened the underwriting rules and people were buying houses not only they couldn't afford, but they had no skin in the game. They were buying them with 0 down or 3% down. So when that mortgage is upside down, or they couldn't afford, their job, or lost their job during the recession of 08 through 10 or whatnot, they just walked away. And so it caused the real estate bubble to burst. And that's where we get into kind of the start of easy money. So, I mean, on this video, and I encourage you to check it out, I mean, Ben Bernanke came out and said, like, this is more or less an experiment. The Fed has never done this. We are going to create this term called quantitative easing. So it sounds all kind of like Greek and sophisticated financial terms, right? But in reality, it was the Fed printing money out of thin air. And the Fed has never had this large of government intervention in world history. Nope. And never before did they buy something besides short-term cash instruments and treasuries and the like, T-bills and the like. Now they were buying mortgage-backed securities, and they came in and said, we're going to buy 25% of the marketplace of mortgage-backed securities. And that's when the ball started to really roll downhill.
Yeah, now they became the lender of last resort. The market got addicted to it. And we're seeing lately, when they started to tighten up and stop doing that, we saw what happened to the economy. And that's really the tail of it. They had to come in and rescue the economy. Now they're trying to tighten. Now the economy's reacting and say, whoa, 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 we still need you here. And so the Fed's trying to get themselves out of it, and they're stuck between a rock and a hard place. And that's really kind of where we are at this moment.
Yeah, I wrote down a couple of good quotes that were in this documentary, and one of them was, the Fed is not supposed to be, the bailout mechanism. It's supposed to be the democratic institutions that do that, not the central bank. And they really kind of got out of the sandbox they were originally meant to be in.
Again, you can tell me if I'm giving too long answers or what have you.
The task of managing most of the program went to Andrew Huszar, a former Fed official who was then working on Wall Street.
I realized very quickly what I was being asked. I was being asked if I would manage the largest financial markets intervention by a government in world history.
The Fed began creating hundreds of billions of dollars to buy things like mortgage-backed securities and government bonds from banks and financial institutions.
This was a $5 trillion market. This was the largest private bond market in the world. And the Fed had never once before bought a mortgage bond in its history. And basically, in the fall of 2008, it announced that it would buy basically 25% of the entire market within 15 months.
And that was your job to do that purchasing?
That was my job, to think about how to get the program done.
Many of these tools had not been tried before. They were definitely like break the glass kind of tools. Like, what are we going to do in order to restart the economy here?
Yeah, it will create a problem. And I think it's become geopolitical. It's not just here in the U.S. The rest of the countries around the world are looking at this going, U.S., what are you doing? For the longest time, it made sense. The U.S. supported that, we protected the world trade routes. We provide the world reserve currency. We would have advantages in doing that. And that makes a lot of sense. Now, I think the rest of the world is saying, okay, the currencies thing is not working for us. You've exported all this inflation to us. And now we want to make some changes there. And I think the rest of the world's looking to make some changes. And I think it's causing, some different geopolitical realignment. And that's normal. When you go through currency cycles, things don't always stay the same. Things will change in different, trade routes, and world powers will realign. I think some of that's coming as well. And for me, the only question there really is, will the U.S. have access to everything they need? Thankfully, we're pretty much energy independent for the most part, especially on natural gas and oil. And we have a lot of what we need. So I think the U.S. has a strong base there. But I do think things are changing around the world. And that's really going to affect availability of goods and services in the U.S. I think we're going to become much more dependent upon ourselves like we used to be. I think it's probably a big change that's coming.
And I actually welcome that. I mean, it's going to come with higher prices. You're not going to be able to buy stuff from China on Amazon for super cheap anymore. And America's going to have to go back to work. And that's the part I welcome. I think part of this age of easy money is the younger working class. If you talk to any business owner, they tend to say the same things. Where's the workers? Like, I can't hire anybody. There's nobody applying, and the ones that do aren't qualified or dedicated. And I think that's because of the age of easy money. And I don't really know where they're getting their money. I'm kind of wondering whether they're getting the money from their baby boomer parents and who are just continuing to entitle them. But speaking of entitlement, I mean, when they bailed out Wall Street, and specifically the banks in 2008, it was specific to those institutions, and the banks didn't do what was right. They took the money that the Fed created. They were supposed to lend it to small business and the real estate market to get the economy and the homeowner, track back going, the train moving. Mm-hmm. Instead, they took it and bought the same items the Fed was doing. They were basically saying, hey, look, if the Fed's going to support the market, let's get in there and make some easy, quick gains. And I love the parts in the video where the market was hitting new highs, bankers were getting huge bonuses, but yet all Main Street Americans were still severely getting hurt. And that created a lot of political shifts as well, when Americans really got tired of seeing the taxpayer bail out the big cats.
The financial sector had begun to stabilize, but there were early signs that not everything would go according to plan.
The banking industry fat cats still aren't lending money.
Well, the big banks aren't lending.
Despite the money the Fed was pouring into the banks, they still weren't back to lending.
The government's not doing anything to help small business, and the banks are sitting on their butts and they're still not lending money.
Instead, they were taking a lot of the money and investing it themselves.
The banking sector is broken. It is not lending to small business. Somebody's got to get the money there. The government is the actor in this case.
No, it's not. No, wait a second.
You were injecting money into the banks, more than $1 trillion worth at that point. And what were the banks doing with that money?
The Fed's idea was the banks would be taking that money and lending it effectively at lower interest rates. What the banks were doing instead was that they were just investing in the same bonds that the Fed was buying. They were taking that money and they were turning around and buying the same mortgage-backed securities and other bonds. Why? Because the Fed had made very clear that its goal was to drive up the price of financial assets. And so Wall Street turned around and thought, why would I go through the effort of making a mortgage when I can just press a button and buy, millions, if not billions dollars of bonds and ride that trade as the price of those assets are very consciously being inflated by the Fed.
𝘎𝙀𝘾𝙊𝙈 grew increasingly disappointed by the program and would eventually leave in 2011.
I hadn't seen the benefits accrue to the average American, and I wasn't seeing larger structural reform in favor of the average American. I began to question whether it was my role anymore to be at the Fed.
Were you seeing that the banks were gaming the Fed, that they were in some ways taking advantage of this program that was intended to help the real economy?
I think you could say they were gaming the Fed, or I think you could just say that they have a different mind and they're not part of the Fed and they have their own interests. It's sort of like the Aesop's fable of the scorpion of the frog. On some level, it's in their nature to do what's in their nature, and in their nature is to make the most money possible in the quickest way possible. And just because the Fed wanted to do something and wanted to help the average American, it doesn't necessarily mean that Wall Street has the same interest.
Yeah, and that's a lot of what happened last time was the bailouts were geared toward, the big banks. And the interesting thing about that time period, I was actually working in consulting, working on mortgage servicing, working on a project around mortgage servicing at the time. All of this is going down, the Lehman crash and everything, the summer of 2008. And I remember having for about 7 or 8 months before that, before it became public what was going on, I had done a project for a large international bank. I won't say who they are, but a mega bank, basically. It was one of our top customers. I worked for Ernst & Young at the time. And they had bought a company that had been a subprime mortgage servicer, and they had run into financial trouble. And when we got the loan packet, 52,000 loans, we got it. They were messed up on how they were servicing it. It was completely messed up. Lots of complaints and lawsuits because people were paying money on adjustable rate mortgages and not knowing whether they paid the right amount because that's an adjustable rate and interest rate. And so we went and had to clean all that up, and it took us about 7 months. And what we found was there was so much paper flying around, nobody even bothered to service it. Nobody even bothered. No one cared. Once they got the paper, once they wrote the paper on the house, the servicers did not care what happened because they got their money and the originators got their money. And so what we had to do in 2008 was go back and build in servicing capability. We built a servicing platform for them so that they could service those loans and do it correctly. And we got all the loans corrected so that the company stopped getting sued for making the wrong payments. And then the investors who had put money into these mortgage-backed securities are like, hey, we never got paid. So we had to do a project to calculate what they would have gotten paid, and get them their money. The whole system was broken. And it was just that we were moving so much paper so fast that nobody bothered to do any of the loan servicing afterwards. And eventually why it came crashing down is because the investors weren't getting paid, and they started pulling out saying, we're done with this. And that's really how the whole house of cards came down, was investors never got their money because they were writing the paper so fast. Because think about what they had to do. They had to create more debt to keep the system from crashing. They were creating it so fast, they weren't adhering to any underwriting guidelines or servicing guidelines. And the whole thing just went into a total mess. And after that, we had the TARP programs and things and foreclosures, and there was a big legal battle around all of this. And I just remember that time thinking, okay, it was the biggest mess I've ever seen, of any project I'd ever done in consulting and an audit. And they just needed to get the paper. It was all about getting that paper out to keep that system from collapsing. But eventually it did come collapsing down because the money never got passed on. People started pulling out and the whole thing just fell apart. And, that's what happens when you get to that frenzied stage of we need to create more debt to keep the system going or it's going to collapse. that's the kind of stuff that happens. And I think maybe we're starting to see some of that again, because you're seeing the ninja loans come back, no income, no documentation. And I see it, I'm a real estate investor, and I see people bidding up houses for 3 or 4 times, what they were worth a couple of years ago, and you can start to see those bubbles come through. So I think we're probably in a period at which we're seeing the same thing that we saw in 2007, prior to the last financial crisis. We're seeing some of the same signs I'm seeing. And now that I had, been a part of that mortgage-backed security mess and saw it from the inside as an auditor and as somebody trying to help fix that problem, I see those same issues now, and I can clearly see where we're going the same direction in the mortgage market that we were in 2007. So that definitely is a big alarm here.
$20 billion worth of bonuses. It is shameful.
Are these executives greedy or stupid? Personally, I am stumped for an alternative word.
There will be time for them to make profits, and there will be time for them to get bonuses. Now's not that time.
It's socialism for the rich.
By the end of 2009, the banks were back to making money and paying themselves record bonuses while the real economy lagged.
Washington loaned them money at cut rates, so our thanks is they're going to stuff it in their pockets, even as many Americans are suffering from unemployment and reduced wages.
People absolutely ought to be outraged. I mean, these guys just don't get it. I mean,
the inflation rate was well below the Fed's target of 2%, signaling weak demand. Unemployment had shot up, and foreclosures were continuing across the country.
Banks got bailed out, we got sold out.
People had lost homes, household net worth had plummeted. It really wasn't an inclusive recovery. It was a recovery that benefited only portions of the economy.
I'm here to support all of the people who want their taxpayer dollars back, and me included.
There was a sense that the banking sector, the financial sector, benefited primarily and not so much everybody else. And that had a political taste to it, which became the basis, I think, for a lot of anger and really set the stage for, sort of the next chapter in our country's political history.
We have you surrounded. Come out with the Constitution intact, you usurpers!
Demonstrators opposed to what they call out-of-control government spending begin a series of rallies this afternoon.
The resentment helped give rise to the Tea Party, fueled by the belief that government spending and bailouts had been out of control, and ordinary people weren't seeing any benefits.
Yeah, I agree. I mean, the whole system's based on debt. I mean, I remember when they passed that $2 trillion bailout under the Obama administration, and I remember saying to anybody that would listen, this is going to bankrupt the United States. And I was completely shocked that it didn't for, the next 12 plus years. But I think, again, there's a delay. I think it still will bankrupt the system because you put that $2 trillion in, and it was a shocking figure back then. But then you have this $2.2 trillion in the CARES Act. And that was just the money that Congress spent. You talk about quantitative easing. I mean, the Fed was raising its balance sheet by like 4.5 trillion or something like that. It was ridiculous. So debt's exploded both on the government as well as the corporate. I mean, corporations use this easy money to get super leveraged in debt. They use it to buy their own stocks back, not to improve their factories or their workers' quality of life. And a lot of people got rich. I mean, there's one quote in this documentary that says that there's 2/3 more wealth in the billionaires than the bottom half of America.
So you're doing a documentary on the Fed and monetary policy?
We are trying to.
Okay.
Are we insane?
No. I think it's a great idea.
Okay.
Joseph Stiglitz is one of the most well-known economists in America and a winner of the Nobel Prize.
The intention of the Fed was to stimulate aggregate demand.
He told me that while the Fed had done some good, he worried at the time that by stoking the stock market so aggressively, it was exacerbating economic inequality.
The main thing I was concerned about was that the way they were trying to revive the economy was a kind of trickle-down economics. The way quantitative easing works is that it's a lowering of the interest rates that leads stocks to go up. And so who owns the stocks? It's the people in the top, not just the top 10%, 1%, 1/10 of 1%. And so it increases enormously wealth inequality. We had increasing inequality really since the late 70s, and this was putting that on steroids.
Yeah, and I remember last year saying that, we just nuked the US dollar when the Biden administration decided to weaponize the dollar and sanction Russia, because the other countries are like, well, am I going to be next? So you see a lot of de-dollarization for that reason, because they don't trust us anymore, because we're not trustworthy. So we're going to have a lot less easy money. I think we're moving into an age where we're going to have higher interest rates. I think that could be a good thing. It's less debt. It rewards the saver. It rewards companies becoming more efficient and innovative and bringing their workforce back to America. I mean, at the end of the day, this entitlement generation that we've raised here, and this entitlement generation that we've lived in under this government, I think is a bad thing. I think it's weakened America. And I think if we were to scale that back, I think it would be better for our long-term national, longevity, if you will.
And then the question was, what else can we do? And the committee came up with the idea of quantitative easing.
Quantitative easing, what in the world is that? Quantitative easing, that's just a Greek term to a lot of people.
A lot of people want to know what they're going to say about what we call quantitative easing.
Quantitative easing, or QE, was championed by Ben Bernanke, then the Fed chairman.
The Federal Reserve is committed to using all available tools to stimulate economic activity and to improve financial market functioning.
QE was an experimental way for the Fed to inject money into the financial system and lower long-term interest rates.
It's almost like alchemy. You can create money out of thin air if you're at the central bank.
Hey guys, what you just saw is part one of a two-part series in which my friend Nathan and I of Independence Money and myself get together and we talk about this really cool documentary on PBS Frontline about the Fed and about our monetary system. The thing that strikes me the most about this is not just the fact that people in the alternative media like myself and many, many others for many decades have been talking about this system, the pros and cons, and how it would likely end up. The fact that we're seeing this on mainstream media when the dollar has not collapsed and when we're still here in the middle of this system, I think is pretty interesting. I think it's an acknowledgement that what we did in 2008 and 2009 as a nation in terms of the QE program didn't work and didn't solve the problem. And it's as much a repudiation of modern monetary theory and Keynesianism as anything else, which is why it shocks me. But I suppose the reason that this is out on public media is it's so obvious the problems with the dollar and the de-dollarization and what's going on in the rest of the world geopolitically that it makes sense for us to talk about it. And I also think they're setting us up or grooming us for, or preparing us, really is the right word I want to use, for the next system. I think the Fed realizes and the government realizes they've got a new system. And I think because they're debuting Fed Now here during the summer, it made sense for the media to address this now. And PBS certainly has done that. And they did a really good job. They interviewed a lot of insiders. There's a lot of meat on the bone here. So we wanted to make a couple of videos to go over that. This first one is more talking about the setup. It's talking about what happened. It's talking about some of our anecdotal experiences and what we saw in the system leading up to today. The second video, which is going to come out in a week, is going to talk about solutions. It's going to talk about the government solution, but more is going to talk about solutions that Nathan and I see to help you prepare and get through this. We think that there are practical things that can be done that you can enact right now. And that's basically what we wanted to talk through, because I think it's time now to have that conversation. I think it's obvious now. Everybody's talking about it. Mainstream media, Fox News, CNN, they're all talking about it. So now's the time to have that national conversation over what are our options and what are some things that we can do. And what we don't want to do is just select whatever new system is out there that anybody can pull off of their bargain pile or their bargain bin and say, let's either go back to this or let's start something fancy and new, which we've never done before. I think we should talk through all of those options. And that's really what these videos are meant to do. So stay tuned. In a few days, we will have the new one out, and we think that you will appreciate it as we continue to review this great piece of work by PBS, but also add our own flair and our own thoughts on alternative solutions that you're not going to see in that PBS video. Thank you so much for tuning into this video, and stay tuned. We will have part 2 out very, very shortly.
Hey, thanks for watching. We selected these videos just for you. Check them out. And remember, $4.99 a month keeps the lights on and the channel going. So join our GoldSilver Pros supporter membership. We appreciate your support. Keep stacking.